Let's see what else. Can you explain puts and calls? So puts and calls are option contracts, and an option contract is kind of like what it sounds. It gives you the option to buy or sell a stock over a given period of time at a specific price. So I remember the difference between the two. So a put is an option to sell, and a call is an option to buy. And the way I remember that is that P is closer to S in the alphabet and B is closer to C in the alphabet. So a put is an option to sell a stock at a given price over a specified period of time. So for example, I might have a put option to sell Apple stock at, and I'm making this up, at $150 a share sometime between now and March of 2023, as an example. Or I might have a call option, which is an option to buy Apple stock at $150 per share at some point in time between now and March of 2023. Those are kind of the critical components of a put or a call option. The expiration date, which is the date the contract is good for, and a strike price, or the price that you are given the option to buy or sell at. Now, you pay for an option what is known as a premium. And so it's usually a small amount relative to what the strike price is that is giving you the right to then have this kind of, flexibility over a period of time at that given strike price. You do not have to exercise an option, right? So if it's what we call out of the money, so meaning if you exercised it by March at the given strike price relative to where that stock is trading, that it wouldn't be to your benefit, you just let the option expire. But if the option is in the money, meaning that if I exercised it today and it would give me a profit relative to current market value, then you would choose to exercise it. So what do I mean by that? Well, if I have the option to buy a stock at $100 per share, and it's currently now trading at $120 per share, well, I can immediately exercise at $100, sell it at $120, and I've made an immediate profit of $20 per share. And I probably only had to pay, a small fraction of that profit for the option value. On the flip side, if I had the option to buy at $120 per share and the stock was trading at $100, then I wouldn't exercise it because that would be a losing proposition. And so I would just let it expire and I would only be out like the small amount or the premium that I paid for the option. So what do people use puts and calls for? They use them for hedging. Hedge funds use, as the name implies, they use puts and calls as hedges against various positions. They can use it as downside protection. If they're worried that the market might trade down, they might buy a put, giving them an option to sell at a given price in case the stock falls below that price, for an example. And so that's their intended use. However, more and more people use them for speculative purposes. It also sometimes allows you to trade in smaller dollar amounts than, say, buying shares outright. But what I will tell you is that options inherently have leverage built into them because they are derivatives, because you are paying a small amount relative to a much larger share price typically. And so because of that, if you don't understand what you are doing, it can be dangerous, especially if you are underwriting options. So if you are underwriting options, that means you are a seller instead of a buyer. So you are receiving that small premium payment in order to give somebody else the option. But if you then have to deliver, you could be out a significant amount of money. So like if you're selling someone an option, they're going to pay you the premium, which is a small amount, but then you may actually have to deliver on shares at, a much bigger share price at a potential losing proposition to you, for example. So that's a little bit about puts and calls. There literally are entire semester classes. Like I took an entire semester course on options and derivatives. So to explain it in kind of 5 minutes is a little tough, but that's kind of the high points and hopefully gives you a flavor for kind of what they are and how they work.